This is a very simple and complex game. Complexities come in your structuring of your deals, but the simpleness comes in housing is supply and demand. That's just basic fundamentals.
Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hey, welcome back to the show. I'm your host, Todd Dexheimer. I'm excited to have Heidi Addo. Heidi, how are you doing today?
Doing well. Thanks for having me back, Todd.
Yeah, so Heidi's with Michel Commercial, Twin Cities brokerage that sells multifamily and sells a lot of multifamily in the Twin Cities. So, and Heidi is kicking some major butt with my commercial. It's been fun to watch your journey, and you've been on the show, I think, like maybe 4 times so far. And I really wanted to bring you on to get a little bit of market insight, what's going on today, what you're seeing as far as a broker, and what you're excited about, what you're nervous about, all that kind of stuff. So why don't we start out by just talking about 2024 and what Michel Commercial was doing in 2024, and then we'll dive in.
Perfect. Yeah. Thanks, Todd. Michel Commercial, we're a boutique brokerage just focused on multifamily. Our firm has been selling multifamily properties in Minnesota for over 40 years. And yeah, we had a brand transformation in the last 4 years. So you're right, we've been kicking ass and we're incredibly busy. So taking a
That's
look
awesome.
back at 2024, sales volume is up in the Twin Cities. It was up for us as well, which is excellent. 2023, of course, was part of that interest rate saga. Things were very unpredictable. That carried into 2024 nationally. Interest rates
Yep.
are national. And however, we're seeing a change. And part of the change we saw in 2024, we're still experiencing a change even at the start of 2025 here. Part of that change is sentiment. Buyers, sellers, lenders are getting more comfortable with the variability of rates and how that's affecting things. I mean, we saw it with sales volume increasing in Q4 in the Twin Cities of 2024. But overall, sales volume increased by 35% in the Twin Cities.
Wow.
And every market is
In
very
Q4 or
overall
2024 overall?
compared to 2023.
Yeah.
Q4 saw record high sales that we haven't 50 properties sold in Q4 of 2024 in Twin Cities. The last time that many properties sold was Q1 of 2021.
Wow.
That was
That's,
COVID. Yep.
yeah.
And that was also part of that really low interest. I sold a property in 2021. They locked in a $50 million property at a 2% interest rate. I think it was 2.2. That will
Jeez.
never happen again. And
Never say never, but
well,
yeah. I think you might have been safe there.
yeah, yeah. So I mean, that was just amazing. But that's a way different market. The 2021 market
Yeah.
was very uncertain as well because of COVID. So rates just went absolutely down to practically zero. And
Mhm.
then we're uncertain still, but now it's the fluctuation that is causing uncertainty. And we're actually uncertain again because we
Yeah.
do have a new administration and some of the things that were said that were going to happen, whether it's tariffs or other, they
Yep.
could send us into a whirlwind. The last time this president was in office, he set off in a complete whirlwind that caused things to be in chaos, which actually dropped rates.
Hmm.
So who knows? But where we are, um, sellers are recognizing, you know what? I was holding out for higher pricing, and I'm recognizing that pricing has possibly hit the bottom. So maybe we're not at the bottom anymore. However, it's stabilized in the Twin Cities. There is some pricing stabilization where we're not seeing these, people might call them like unicorn sales, where you've got this just, there was a time during peak market, 2021, 2022, every sale was a higher price.
Yeah.
Every
Yeah.
sale was a higher price.
New
We're not,
records.
yep, yeah. We're seeing pretty stable. I'm selling a property right now in this submarket. It's in Anoka County. And every property that's sold in the last 6 months, it's a Class A property, brand new development, is pretty much at the exact same price per door price
Hmm.
point. And the
Interesting.
reason is because that submarket has very similar rents.
Yeah.
And so now we're not to a cap rate compression market, we're to a what is the value of your net operating income? That's where we're at. And how much IRR can I get to be in the mid-teens, depending on if you're a short-term, under 10-year holder, or what's my cash on cash going to look like for the 10-year plus hold of this property, depending on what type of buyer you are.
Yeah. Yeah. Interesting. Um, what are so you mentioned the interest rate difference, obviously in 2021, and we were lucky enough to get a couple of great interest rates in 2020 and 2021 as well, and actually assume a great interest rate from that era. But beside that, what's the difference? I mean, 50 properties, the most since the height of the market, which was the most like ever. Um, so that's really great news that people are selling again. What's the difference? Like, besides the interest rates that you mentioned, why are people, I guess, what's the difference between 2021 and now, and when maybe what's getting these sellers to go, let's go, let's sell.
Yeah. So in the Twin Cities, debt maturity is part of the situation.
Mm,
So you've got 5, 7 year debt. It's starting to mature. And
yeah,
there was a ton of refis in 2020. Well, now we're in 2025. That 5 year debt or that construction loan, those are coming due. So in the Twin Cities, we have a financially conservative market of people. People are not super risk takers as they are maybe on the West, East Coasts,
yeah,
Southeast. And so while you have a more conservative population as far as risk appetite, 5 year debt still comes due. And if you locked in, and here's another thing, if you underwrote your deal only to work at a 2020 interest rate where rates were 2, 3, sub 4%,
yeah.
5 years comes, there's been an influx of development in the Twin Cities and in national markets too. So you didn't see the rent growth possibly. And so when you look to refi, maybe you just want your capital back. A lot of developers want their capital back. It's very expensive to build. So you want your capital back. That's a sale or a refi. If your refi is not going to give the capital you want, maybe you're going to sell. So that is definitely the impetus for a developer to sell right now is their debt maturity. As far as other portfolios, so more vintage portfolios, whether it's a class B or C property, debt maturity still could be an issue. Or not an issue, but just a consideration.
Yep.
But also for a long-term holder that purchased a property 20 years ago, their
Yeah.
basis in that is so low already. Sure, they missed the peak of the market, but the truth is it's gotten more challenging to operate vintage properties. If you're not improving your property by doing a value add, like Todd, I know your team does, your resident base can slip in some pockets and submarkets. So, for example, client I was talking to a couple months ago, he's got 300 units in a pocket of this city called West St. Paul, not connected to St. Paul, a different submarket, different
Hmm.
county. Great, actually supply constrained submarket, and rent continue to improve in that submarket. He's got original 1960s, 70s property, and he has it at about 20% vacant.
Wow.
And it's not for lack of applicants. He has so many applicants, but they don't meet his criteria.
Hmm.
So that property has actually seen the decrease of the quality residents. Now, I don't recall his exact what he considers a quality resident, but if you're over 550 credit scored with no evictions, no criminal history,
Yeah.
let's just use that, or 600 credit score. Let's just use that as kind of a base. This is not particular to that person, but just using that, if you are not improving your properties in a submarket that's really growing and expanding and has had quite a bit of income growth, job creation, you're actually only able to attract a lower type of resident.
Very true.
So it's that becomes a challenge. That owner does not have experience in improving properties. So that's where he reaches out to me and I say, you know what? You can do all this work to improve your property, but if he doesn't have the infrastructure like your team, Todd, does to have all the people doing all the improvements,
Yeah.
not
Well,
able.
and the capital handy too. Like,
Yeah, that's true. That's very true.
Yeah.
And then he calls me and then we value it and then we sell it pretty much.
Yeah. Yeah. No, that's great. And those are the deals that we love because those area, as long as the area is good and can support that resident that meets that criteria with an improvement, then hey, that's potentially a very strong deal at the right basis. And that's what we're seeing right now is that even though deals are really it's still really tough. It's not for us as buyers. Like it's really tough to find good opportunities out there. But when we do, we're excited because our basis is so much lower than it would have been just a few years ago. We're finding that deals that we can get into are actually can cash flow, which is great. That was a challenge just a few years ago is to cash flow. You just had to count on rising values. And now it's like, no, we're not going to count on rising values. We can't. We have to count on there being cash flow. And so I think there's been a change in buyer sentiment, and it feels like sellers are starting to get there a little bit more. I mean, I'm sure there's plenty of lofty sellers out there, but it feels like we're getting to closer to this equilibrium. Maybe not quite there yet, but I feel like it's getting there, and it'll never. There's always going to be, if you're a buyer, it better not be easy. Like if it's easy, you're doing something wrong, by the way. So, um, I guess maybe not always. If 2008, 9, 10, it was probably fairly easy, but even that it was difficult because you didn't know what was happening. You were afraid that rents were going to continue to decline. You were afraid that vacancies were going to continue to go up. You thought, I mean, I remember owning single families and duplexes between '08 and probably 2012. So 4-year span there, Heidi, where the buildings that I owned, I had a high eviction rate. It took quite a while to get qualified tenants into my buildings. And so it wasn't just an easy, like quick turnover. I got zero vacancy. No, I was evicting. I was having a hard time qualifying people. And it kind of turned the corner, maybe 13 or 14, somewhere around there, where all of a sudden it was like, okay, I haven't had an eviction now for, wow, we went an entire year without an eviction. But then it was really hard to buy a property, right? And because it was super competitive then. So I don't think it's ever going to be a time where a buyer's like, oh, this is so easy. You're probably doing something wrong.
And I wonder, to that point, Todd, like everyone always talks about the great financial crisis as like, oh, I should have bought everything. I
Yeah,
wonder if we're actually in that time right now because
we
maybe
could
this
be.
is where you should be buying stuff because, for example, property that your team bought already in North St. Paul from an excellent operator, that the value of that property was 20 to 30% higher when interest rates were lower.
Yep.
And so you bought it to your point, you bought it at a bit better basis. And it was probably still challenging to do just because you're really, you're looking at nickels and dimes when interest rates are really high. You gotta, like, every number really counts.
Very true.
But if you can lock it in now, and let's just say your team owns it for 10 years, you're going to improve the income, you're going to improve the quality of the property, resident base. If you do go to sell it, I'm just projecting in 10 years, likely value is going to be much higher than that basis.
Yeah.
So I think that this could be that time where people are going to look back and the elevated rates are going to be something that people are like, oh, I really should have bought.
Yeah. Yeah. Here's where I say to anybody listening that's a buyer is that it doesn't matter if today is the best time to buy. What matters is if you can hit your fundamentals that make sense for a buy. Because if it is a great time to buy, you're going to be kicking yourself that you didn't. You don't know that it's a great time to buy until that time is long gone. Right. So nobody knew 2000. Like if I bought a big apartment building in 2010, that was a scary time. And I had no clue if that was the great time to buy that apartment building. But by 2016, I was like, holy cow, that was a home run. I wish I would have bought 30 more of those deals, right? The same thing's going to happen this time around. I don't know when that is, But the same thing is going to happen. There's going to be a bottom at some point in time, and the top's going to be much higher than the bottom. And you're going to go, man, I wish I would have bought in 2025 or 2026 or 2020, whatever year that is. I wish I would have bought everything then. I do know from my experience in 2008 and 9 and 10, prices were still going down, but I was still buying and prices were going down. I don't regret any of those purchases in 2008, where the bottom of the market didn't happen until 2012.
Interesting.
So,
Interesting. Yeah.
so
Now taking off my broker hat, I invest in a lot of deals, and I'm actually getting my money out right now in a big way because of that exact thing. Like, I think this is like a low point in the market. And so I'm heavily investing right now for that purpose because I'm betting on myself, I'm betting on the market, I'm betting on my knowledge of that I have, and I'm betting on where this market has been. And so just talking about market fundamentals, Midwest has been a sweetheart. And I know your team's invested
yeah,
in the Midwest. A lot of places have been. Where the Southeast, I'm talking, Florida, other South, Florida is kind of a main thing, but Tennessee, other places have also done super, super well. They're also recognizing negative rent growth in some submarkets there right now. Here we haven't. We continue to have job growth. We
yeah,
continue to have wage growth. Our rents have always increased, even if it was just marginally. Rents continue to be up. And there are only a select pocket of submarkets within our urban core, Minneapolis and St. Paul, that have actually seen declines. And don't get me started on this topic, but St. Paul is actually showing some of the highest rent growth since they implemented rent control. But let's not even go.
but
Rest
it's but it's important
anyone
to
listening out there in the political realm, rent control is not the answer. More
yeah,
housing
right.
is the answer.
Yeah, and we've seen it, right? And so I'm actually writing a blog article on the worst markets of 2025, and guess what? They're all markets with the highest supply. As far as the worst markets that we're going to see in 2025. And those worst markets, by the way, part of the article that I'm writing is talking about how those are the worst markets today, but they're probably the best markets for the future, because once that supply gets absorbed, they're very high growth markets. But to that point, you're seeing in all of those markets, we're seeing pretty good rent declines. I mean, we've a couple of the markets, Austin, Texas, Charlotte, which other ones? San Antonio. They're all seeing like 6 to 8% rent declines right now, which is pretty amazing. And the Twin Cities is definitely not seeing that. It's slow, steady Eddie, which is what we like about the Midwest in general.
Yeah. One thing too about developments, I thought this was a super, super interesting stat. I think it was Austin, but fact check me. It was a submarket, a really thriving submarket in Texas. They had 60,000 new units. And to just quantify that, the Twin Cities market has 290,000 units total.
Yeah.
So 60,000 units came on in just the span of a couple of years. That is incredible.
That's incredible. Yeah. Well, so Austin, over the 5 year period of time, has seen an increase of their market by 30%, just over 30% increase in units over the last 5 years, just 5 years alone. So it's crazy.
Yep.
Um, Heidi, what you mentioned St. Paul? So where are buyers' appetites right now, and sellers, where are they getting maybe aggressive with wanting to sell? So are there certain submarkets that you see or certain trends that you're seeing where buyers are really excited about, buyers are really cautious about, sellers are really excited about? Are there certain submarkets that you're seeing?
Are you wanting to talk about St. Paul or are you wanting to talk about submarkets in the Twin Cities?
Submarkets within the Twin Cities. It can be St. Paul, can be one of them. It doesn't have to be.
Sure, sure. I didn't know. Well, let's use St. Paul as an example to start with. So, we've been really active selling in St. Paul recently. We just sold a property off Groveland, which is a really desirable place.
Yeah.
A couple buyers, one buyer in particular said, this location of this property in St. Paul is similar to lakefront property. So we actually sold that for cash with in a quick close situation where there was competitive bidding, and that's how the person got the deal done.
Hmm.
So it was also an excellent operator. But let's take a look at that submarket and how submarkets are so important because they are not all created equal.
Yeah.
That is prime real estate in the city of St. Paul, despite rent control. That was an all one bedroom, mostly one bedroom property. Okay, juxtapose. Oh, I sold that for about 124,000 per unit, which is over the Class C. It was Class C building, 1960s vintage. That's well
And
above
one bedrooms.
all one bedrooms.
Yeah.
Yeah. Well, juxtapose that, I just sold 60 plus units in East St. Paul, which is a lower income area, different resident base, and I sold it for 60,000 per
Hmm.
unit. And those were mostly two bedrooms.
Hmm. Wow.
So the submarket really matters. The rents are very different. You know, the
Yeah.
rents were 40% more on Groveland than they
Yeah.
were um, on where I sold in East St. Paul. So submarkets really matter.
A lot.
Example of St. Paul proper, but taking a look at submarkets that are leading. So I've said this, I'm really active on social media. Our team's actually the social media leader in Minnesota and definitely in the Twin Cities. But let's take a look at Anoka because Anoka is really showing strong absorption.
Hmm.
And when I say absorption, what I mean by that is that there were a load of new deliveries or new construction that took place in the last 4 years, 5 years in Anoka County. And currently, the next 12 months, there is zero new market rate
Wow.
delivery. There's one deeply, deeply affordable property, but a deeply affordable property with
Yeah.
government restrictions has no context to market rate.
Yep.
And so Anoka County is already showing a 5.3% vacancy rate. Their vacancy rate dropped by 303 basis points in
Hmm.
14 months.
Wow.
Anoka County is on our radar as probably the county that's going to experience the highest rent growth in the next 12 months. Are they going to experience the highest rent growth in the next 40 months? No, probably not, because it's still Anoka County, compare it to Hennepin County. The wealth is still mostly on the west side of Hennepin County in Minnesota.
Yeah.
And so where do people want to live? Here in Minnesota, people want to live if they have families. They want to live it with great school districts. People are definitely favoring the suburbs, not just in Minnesota, but nationally.
For sure.
There's going to be a push now. It's going to be an interesting situation with this new administrative push to, for sure, all government workers are going to be going back to work. We'll see if other groups, you know, in our market, is Target going to be a part of this back to work? That may shift things back to the city again. But the suburbs have definitely been where residents have been moving out to, and that's where the development has been as well.
Yeah. I think the answer to that is yes, 100%. There's companies that are going to be moving back to the office. Maybe not exactly what it looked like pre-COVID, but a lot more closer to what it looked like pre-COVID than it did during COVID. We have somebody who's pretty high up in Amazon and that we know, and they're going everybody back in office.
Wow.
And then I've heard rumors, same thing about Target. They're going, back to the office. So I think more companies are going to be doing it, and that's going to play definitely a factor into multifamily, of course, office buildings too, but how multifamily functions, and you might see some more excitement in some of the urban core,
Yeah.
which is a good thing. All right, I think a healthy downtown creates a healthy city
Yes.
overall.
I totally agree. And actually, I think that would be a great thing because the Twin Cities, so there is a housing shortage nationally. In some of these pockets, like we talked about Austin, for example, maybe the housing shortage isn't going to be seen as quickly, but when there's no, the production of housing is muted for the next 2 to 4 years, depending on where interest rates go,
Yeah,
we're going to return to a housing shortage. And in the Twin Cities, we are short we need 18,000 more units by 2030.
hmm.
There's no way that the current projections, so we just had about 10,000 units come online in the last 12 months in the Twin Cities MSA. We've got, I'm going to round up about 6,000 coming online in the next 12 months. And from there, I think it's like less than 4,000 in 24 months. and
Wow.
project more.
That
So
you just answered my next question. I was just going to ask you about new development, what you're seeing. Where are those units being built, in the Twin Cities?
suburbs.
Suburbs.
And
Yeah.
so if you're looking at the Twin Cities, I talked about Hennepin County, those western cities, for example, Maple Grove has had so much new development. They still have new development, and there's quite a bit of rent to build to rent homes
Yeah.
communities, rental communities coming into Maple Grove. And Maple Grove has done a great job of actually absorbing that. So that's a market that's really showing strong absorption as well. But there's new deliveries. There's been quite a few in St. Louis Park. I don't know if your audience wants to get into all the Twin Cities submarkets, but there's been a lot of new deliveries. And but in some, I'm going back to Anoka County, we're seeing that dichotomy of where you've had new deliveries, you may have elevated vacancy rates. Where you've had a lack of new deliveries, you have lower vacancy rates. It's just
Mhm.
supply and demand. And
Yep.
so in the Twin Cities, I think it would be a great shift for people to move back to the downtown because there it's about 8 to 10% vacant in the Class A properties in downtown, and rents have decreased and their operational expenses have increased based on safety and other factors.
Yep.
So if some of that population were spread out and come back downtown, that could help some of this housing security in our cities. But yeah, we still will have a shortage.
Yep. Yeah. It's funny. We talk about the Twin Cities and there's been rent growth. There's not really high vacancy rates, but then you just mentioned certain parts where the downtowns, there is rent declines. There are high vacancy rates. And then you've got some of Anoka County, for instance, where man, I mean, there's going to be some probably bigger rent increases, especially Twin Cities wise. And there's, not that much vacancy, and it's going to continue that's going to continue to get even erode. And so stronger occupancy. So no matter what market you're looking in, that's the key is you got to dive into truly the submarkets, and within the submarket or within that city, like the true submarket, like you talked about, McGroveland and versus east side of St. Paul and the differences there. That's so important to be looking at.
Yeah. One other thing, just as we're talking about like renters and where they're going to be, renters are going to be renting for much longer.
Mm,
We were just at that the same apartment summit, Minneapolis Twin Cities Apartment Summit, and the average age from a renter was homeowner was 31 years
yeah,
old. People would buy their first house at 31. It's now 37.
that's wild.
It is wild. And so now let's just say many people at 37, you maybe have a partner, maybe you have a kid, and you're going to be renting for longer. And your income has likely increased since
Yeah,
you've been 31. So you're going to be looking for that higher type of property, and you're willing to pay more. And that's where that build to rent home comes in as well. Maybe
yeah,
you don't have enough for the down. Maybe you can't compete in a really competitive market. And that single family home market is going to continue to be tight. I live in Plymouth, and the only homes that are being developed are 1.2 million or more. And you don't even get a deck at that price. And you get a corner, teeny
yeah,
postage stamp, but the house takes up the
yeah.
entire lot.
These aren't mansions being built. These are just
Yeah.
regular homes. Yeah. Ah, man, that's crazy. So, and we'll talk about that too. Is rent affordability in the Twin Cities? Rent has been going up, but rent affordability is still pretty strong.
Yeah, 18.9%. National average is about 27%. So super strong. It helps that our wages are really strong. Our
Yeah,
residents are super wealthy. Just under $100,000 is our average income and household income.
yeah,
So that's really strong. I mean, I know, Todd, you're involved in some southern states and they're doing great too. I'm not knocking any southern states, but I just know incomes in southern
much
states
lower.
much
Yeah,
lower.
yeah. Where our median income, I think you're right. It's like 95,000, let's call it, somewhere around there. And a lot of these cities that we're in is in the 50s or 60s for median income, like 60,000, call it. So it's a big difference. Makes a huge difference. Now, at the same time, rent affordability is rent affordability. So you really have to look at it. But what I think it plays to in the Twin Cities is we are a very affordable place for people to live, and we have room to grow rents and absorb that if we need to, or if we can, right? We can absolutely absorb it. People aren't being stretched super thin here.
Right. And I just saw it was on social media. I just saw a LinkedIn post about Minneapolis. If you look at like where all the markets are nationally, Minneapolis was pegged as the expansion market because we've had some recent construction. It's getting absorbed. We have continued rent growth. We have continued income growth. And so we're very much in expansion mode. And I love that. And we're seeing that also with buyers. But there are a bunch of new buyers who are buying larger assets so that they can get more economies of scale with one purchase to enter
Mm,
our market. So
yeah.
that new to market buyer is much more common. It was common before um, rates went up, but it kind of paused for a second. But now, as rates are kind of whether they're stabilizing or whether people are just used to the swings now, people are taking a look at us again. Not just taking a look, but like taking a chunk out of the market. There was a recent property, 400 units in Maple Grove, kind of Brooklyn Park area and brand new to market buyer. There's another property in Minneapolis that's going to be selling soon in Northeast, brand new to market buyer. I'm
Mm,
selling property. This is the buyer's second purchase in our market. And they were willing to be aggressive on it because they realized that that first purchase was a great purchase for them. And now they have greater economies of scale with more units in one area. It helps their staff with their operational efficiencies.
yeah. Yeah. There's a lot of truth to that. Getting into a market and just having one or two properties is tough. Once you start to really get some efficiencies going with scale, it really helps out a lot, and all your properties will thank you for that because just having that efficiency is a massive help. Um, uh, so I want to hear what sellers you're kind of hit on it a little bit, but I just want to hear, and I'm hoping you say everybody's ready to sell. Uh, what are sellers? You talk to a lot of people all the time. You guys are giving a lot of broker price opinions, and you want sales, right? You want people to sell their buildings. What are sellers thinking in 2025? Why are people selling? And then why are they not selling? And I
Yep.
guess, okay, why are they selling? Why are they not selling? And are you feeling like sales volumes going up? So it's a three-part question, really.
Sure. Well, great question. So we'll kind of break it down too, because let's talk about the debt maturity piece. So we are valuing 300 to 400 million right now of new developments. And the debt maturity is a factor as well as recycling capital. So those are the main two factors for the new development
Are
class.
those cash in sales, like where they're going to have to bring cash to the table, that, or are they
No.
just, we're just trying to make a couple bucks, break even, maybe make a lot in some cases, but
Yeah. So the ones right now, they're new developments. So they're within 5 years. So these are construction loans that are coming due.
yeah.
And they're pretty much looking to try to get something for their investors or almost a break even because
Hmm.
these groups that we're working with, they're not going to do a cash in. That would not be good for their history of their investor groups.
Yeah.
So it's better to just make a little bit or maybe break even. Or in some cases, one of the investors we've worked with, they actually sold a property and they personally, they're a 20% owner. They took a nothing on it. So they, in a sense, they didn't take any funds. So they were able to give their investors back the money plus a little bit.
A little
So
bit.
I'm not sure about what the groups that we're evaluating are going to do,
Yeah.
but I do know we are very much tracking the time they have left on their debt. And so we are gauging it. We're valuing properties. We always value properties optimistically. Our goal is always to maximize the seller's price. And we're also giving real valuations because they need to plan what they're going to do with that capital. That is
Yeah.
their main consideration is we need to sell this property because A, we have properties everywhere else. We need the cash to keep those going.
Yeah.
We need to keep our construction team busy. Otherwise, we lose them. And if your business is to build, you got to keep building.
Yep. Yep. We
So
just bought one, and that was the reason. I mean, we got it for a pretty good price. The builder definitely didn't make much, if anything. Looking at just kind of his construction costs and his loan that he had on it, he probably didn't make anything, him and his investors. But he has other projects going on, and he had projects that he wanted to get in the ground. So it's just, hey, I would rather make zero on this and recycle my capital and move it on to the next deal than sit on this thing and, maybe I have to lose money eventually.
Right. And a developer. Remember, a developer also gets a development fee at the beginning of their development.
Yeah.
So they get paid in different ways. And we're selling a property right now that it may look like they made nothing, but they actually made to develop the property,
Me.
they got a developer's fee. And it's
Yep.
significant, not a small fee.
Yep.
So there's different considerations with that. But we're tracking, we're timing it. We're valuing an entire portfolio of new developments right now, trying to help them understand which properties would be best to bring to market. They don't
Mm.
want to sell them all
Mm.
because right now is not a favorable time to sell. But if you do need the capital or you do have a reset coming to your loan, you're really going with both those angles. You're talking to a broker, you're getting a value to sell, or you're talking to a lender and you're trying to get it refied.
Yep.
So those are kind of the two considerations. Um, but then for other buyers, if you're asking us to value a property, you have a desire to sell. And oftentimes, right now, we're also seeing really savvy investors. Todd, you might and be in this category. My brother was just talking about this. He's got some personal small duplexes,
Mm.
and he's thinking, I might get rid of all that because
Hmm.
now's a good time to buy. So I
Yep.
want to take that capital and buy. So we're doing a ton of broker opinion of values. We've got a full 3 townhome, it's affordable portfolio though coming to market soon, all townhomes. And we've got 18 units, 52 units, 32 units. That type of property is too small for this owner. It's onerous to operate because they operate at scale of hundreds plus units.
Yep.
So we're seeing a lot of that, really savvy investors who are recycling, getting rid of the small, leveling up, getting into better submarkets. We're doing a lot of that right now.
Mm. That makes a lot of sense. Do you feel like 2024 is going to, or 2025, sorry, is going to be a big selling year? Like, do you, obviously it's early. We're sitting here in January talking, right? So it's early. We don't know yet, but for what you're feeling and hearing from sellers, what do you expect?
Yeah, I think sales velocity is going to be increased again. I think Class A sales velocity at the Q1, Q2 is going to be muted. But if there's any type of downward momentum on interest rates, Q3 and Q4 with the brand new stuff, they're going to be coming to market because they of the debt consideration.
Yep.
Now, we are bringing 7 properties to market in the next 3 weeks, and that is all vintage property. And then we've got stuff slated to come to market in April and other kind of months, just based on where the sellers are at, whether they've got, what their debt, whatever it is. So
Yeah.
speaking to our pipeline, it is robust. And we've got 4 graphic designers that are constantly busy, 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 which is great. But I'm just saying that because to tell you that there's a lot of product coming to market. And a lot of it is great product too. I think that the idea of people needing to sell because they're in financial strains is not our market. That's not Twin Cities. That is a lot of other markets, but it's not the Twin Cities. So that kind of distress we're really not seeing. We're seeing people retiring, getting tired of owning stuff, realizing some things are too small for them. They've leveled up, or their debt's coming due and they want to do something with that.
Yeah, that was going to be my next question too. I've asked you that plenty of times, like, where's the distress? When's it going to happen? And you always have the same answer, like, we're just not really seeing it. I do know of a few groups that are in distress right now. Most of them are smaller assets, and they bottom right at the peak, but for the most part, we just don't see it. And even the distressed ones, it's really hard to make those deals work at this
Yeah.
point in time.
And a lot of that is in Minneapolis, truthfully.
Yes. Hmm.
And there are 10 units, there are 20 units. And
Yes.
it was a time also when people felt that anyone could buy real estate on the side. And when you bought it on the side, you maybe bought in a location that you didn't know very well. And I'm talking to I was talking to someone, advising someone on a property. I sold a property. He was buying a property just 2 miles south. And I said, it looks like very similar location.
Yeah.
Those two locations are incredibly different. And the price that I sold this for, I don't think you should pay for that.
Yeah. Yeah. And that can happen so quickly, especially in those urban core areas. You go 2 blocks and you can be in an entirely different neighborhood. You go 5 blocks and oh my goodness, like the price per door difference should be pretty drastic because they're two totally different neighborhoods. I mean, I can think of plenty of neighborhoods and we can pinpoint them in Minneapolis, in St. Paul, even some of the first ring suburbs that are exactly that. Like you just, hey, 5 blocks is a big difference. Like that's the difference between being on this beautiful lake or being right off the highway type of thing.
Yeah.
So,
Yep. Absolutely.
well, Heidi, what else have we missed that you're excited about that you're seeing? Maybe that is there anything that you're just like, ooh, I don't know about what's going on?
Mm. No, I always know what's going on. No, I'm just kidding.
Yeah, you're always excited. I love we were at this conference, like you said, and the brokers were on first. I told
Always.
the guy that ran it, I said, you're a genius, man. You put these brokers on first. They got us all excited. All of us are super excited. We're optimistic. We're happy because the brokers come on and they just are pumped, right? And everybody is excited about it too. And I said, well, and then you put like me and some other people on there and we kind of popped the balloon a little bit, but by that time we are all excited anyways. And so it wasn't too bad. But
Yeah.
do you see anything that you are going, this could pose a challenge in 2025?
Well, I will tell you that if you're expecting significant price growth, sale price growth, and if
Yeah.
interest rates don't change, don't expect it. The
Yeah.
only way that your price growth can, your sales price can increase is if you drastically improve your income. And I'm
Yeah.
not talking 5%, I'm talking 20%, or if interest rates meaningfully change. So those are the only ways that in our current marketplace, you're going to see significant price increases. So I would say just hold off if you're thinking that rosier days are now, because I know some people were saying, oh, after the election, maybe,
Yeah.
and but it hasn't played itself out today in the 10-year or the 7-year treasury. So rent growth is on the horizon, especially for those markets that have absorbed all the new construction. There's very limited new construction. So it's very simple. I feel like this is a very simple and complex game. Complexities come in your structuring of your deals, but the simpleness comes in housing is supply and demand. That's just basic fundamentals. So when you kind of can pull back some things, I always say make offers that you can execute and that you feel confident in. Kind of Todd, what you were saying, like stick to your underwriting criteria that you can tell your investors, I can do this. Um, I'm predicting very intense rent growth, but I'm not in my underwriting of deals. I'm not projecting that. That's just in my mind of what I think
Yeah.
is going to happen. But I'm not underwriting it. I don't suggest you do.
Right.
Um, but then also, this is a great time to buy. It's a hard time to buy. It helps a lot if you've got lender relationships because lenders are willing to work with people they trust. They
Very
are
true.
less open to working with people they don't trust
Yeah.
because of
Yeah.
so yeah.
Yeah, I think it's important. Real estate's a slow moving game. So if you think that all of a sudden we're going to see this big expansion in prices and like, 2025, I'm really excited for it as a seller and I'm going to sell in 2025 because prices are going to skyrocket. Like that's just not real estate. That's not realistic. The realistic is it takes from the last peak to where the prices catch up to the last peak ends up on average, and I've looked at this several times, is between 5 to 8 years from when the
Wow.
last peak to when it catches back up to that peak is 5 to 8 years. And its peak would arguably be in 2022. And so we've got a couple of years left minimum likely before we even touch that last peak of, and that's not exceeding it. That's just getting there. So
Oh,
it's a
I
slow
didn't know
moving.
that.
Yeah, well, maybe I'm wrong. I don't know. Fact check me, but I feel
No, no,
like I've studied it enough to be right. We'll see. I mean, every time is different, right? But it seems like kind of a lot of similar cycles. They go, not exactly the same, but similar timelines. And real estate, just in general, is just a slow moving machine. It just is.
One more thing I like to always try to give buyers advice. I feel like maybe that makes up a lot of your listeners.
Yeah.
And something buyer advice. Maybe this is counterintuitive, but a lot of institutional groups who often are competing and able to maybe expand their offers to offer more higher prices. They're looking for newer assets, 1990s or newer. So
Mm,
I think there's a real opportunity for more vintage assets. If your team is willing to deal with some of vintage properties, older boilers, maybe some older windows, just the things that go with some like older properties. I think there's a real opportunity with those properties
yeah.
because there's a whole segment of the buyers that are no longer looking at that. And it's simply because of their underwriting and their investors. They want to be more conservative. And insurance is, there's premiums for
For
older.
sure.
So there's a lot of factors, but I think there's an opportunity, especially for a newer investor or a smaller syndication group, or even a larger syndication group like yours, Todd, to get some older properties. There is a property, there's a portfolio that we marketed in Champlin. We had 20 tours, 14 offers. That's a 1970s product. Well, another portfolio, I'm just kind of juxtapositioning a newer one uh, that we had a totally different buyer pool. My only point here is just that the buyer pool is very, very different with the age of properties. That used to not be
Right.
the case. And so there, if you are a younger, more hungry, willing to do a little work, maybe a little more gritty of an investor, there is a whole swath of properties that are ready for you, and renters are already renting in them, so there is income to be generated.
Yeah, I think the people that listen to this podcast are pretty smart, but just in case you're not, um, make sure you understand that older properties have their own challenges. And so understand those challenges before you just go make an offer. It's different than a 1990 built property, a 1970 built. They're very, very different properties. And they both have good value to them, but they also have different challenges to them. So, but I think most people understand that. Well, Heidi, really appreciate you and in your time, and we'll get you on maybe next quarter to talk about more of what's going on in 2025 as we've seen it play out a little bit. And but I appreciate your time, the value you've added to the show. And man, Michael Commercial, how do they get a hold of you, Heidi?
Yeah, find me on LinkedIn, Heidi Addo.
Awesome, Heidi. Again, really appreciate you. You have a fantastic rest of the day.
Thanks, Todd.
Hey, thanks so much for listening. I appreciate you being a loyal listener. Say, I would love to have you go on to our Facebook page and subscribe. Give us a thumbs up. Go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out. And we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.